Welcome to CEO Michael Yorba. Thanks for joining us. I've got Gaurav Chakravorty. He is the CIO of and co-founder of QPlum. Gaurav, give us some background on QPlum.
So QPlum is an asset management firm. We manage money for families, institutions, and high net worth individuals. But you know, what it really is, it's our mission to make investing a science. And I was very fortunate to be. I was at Wharton School where I was, and computer science department joined. We were doing machine learning research, and Dr. Michael Steele at Wharton really taught me how to use machine learning in finance. The first course was literally financial applications of machine learning. And I used those same ideas just out of school. I joined a small company, Tar Research Capital, and I did really, really well just using machine learning that I've been learning. And then onwards, I started my own company, and this is my third company, in fact. And I was able to use machine learning consistently and through the crisis. Now our mission at QPlum is to use this powerful tool of AI, machine learning, and package it in a way for institutions to have lower fees, higher, more consistent returns, more control, and to really make it something that works for them as opposed to something that works against them.
I got it. You know, I've been trading since 1980. Futures, foreign currencies, equities, you name it, I've traded it. And I'm a technical analyst from way back when, price pattern analysis. And so I've been doing AI in my head, but you finally got to a point where there's no, if I understand this correctly, there's really no interpretation relative to humans being involved. It's now machine learning interpretation of all of the things that have been discovered when it comes to market timing, trend analysis, and also volatility, from my understanding. Yeah. I'd like you to break that out from a guy who actually knows the topic from well over 30 years of being in the business. So talk to me about that.
So firstly, I don't know as much as you. I mean, you know, there's some things I know, and I stick to that. But I think the thing about finance is it's not one against the other. It's a buildup of many ideas.
Right.
And even in your trading, I'm sure every day you would wake up and try to see what's new out there. How do I look at markets differently that sort of complements what I'm currently doing?
Right, yes.
We're doing the same in AI, machine learning. I use the terms interchangeably. Every day we try to see what the current set of strategies are and figure out the weak points, like the points where it loses money, and try to find a complementary strategy, complementary approach, complementary set of indicators, volatility prediction, all of that to just do well on my current weaknesses. It is kind of no different than, you know, I was listening to how Nadal prepared for Wimbledon and later years of his career. He said that I have some strengths. My forehand is my strength, but my backhand is my weakness. And I would just prepare that. I would just focus on that. It's very similar to what we do in trading and what a machine does in trading. It tries to really hone into its weakness and then optimize.
Tell me where AI is being used in today's investing with what you've brought to the table.
So the fact is, I mean, not speaking about us, but about others, there's a lot of talk on AI, but almost nobody's using it. And that's because AI, you know, you need a lot of education to know what machine learning is and what it isn't. And when it comes to money, you don't want to just try something that you don't really know. There's a lot of fear, apprehension attached to making a mistake, and then, you know, there's career risk, political risk, every sort of risk of doing something you don't know. Now, what we are doing is first focusing on education. Sure, we have great tools, great returns, but so does everybody else. Our point is not to say that we are the best at returns. Our point is to say that we want to drive adoption of something that I've seen work very well for me, but I need to break it down. I need to give it in bite-sized information. For large institutions, we work, for instance, with the pension fund. We are actually writing the same code. We are working with their engineers, and for asset allocation strategy for them to use in-house with the sort of visualization that will help them get a great idea of what it is doing and what it's not doing. So the education, visualization, these are the important parts for adoption of AI.
Okay, now let me drill down on that. You're talking asset allocation as the market is moving either for you or against you to be able to optimize the ROI as the trend continues, or even, let's say, a non-trend, a sideways market, which is in itself a trend, but go ahead. Is that right?
Yeah, exactly.
Okay.
So asset allocation tends to be an underused area of returns for large institutions.
Absolutely.
For any billion-dollar institution, security selection can add only a little bit, as even Yale Endowment, etc. They have hypothesized that asset allocation drives most of the returns. But many institutions, they're very slow in their asset allocation process. They change it maybe once in 4 years, or maybe when there's a crisis. What we are doing is using AI every day to change asset allocation a little bit. So for instance, when the unemployment number comes out, looking at, and it's just not a number, there are 226 different series. You look at all of that and you say, okay, this is what it says about the sector. This is where you see prices peaking, and you need to reduce your allocation to that sector. For instance, technology as a sector has great fundamentals right now, but it also has a lot of inflation headwind. And you can read that from the numbers and use that in your asset allocation.
What other parts of computer science are needed to build an AI-based firm? I mean, we were talking about trading, and I don't want to get lost in the weeds for the audience, but
Exactly.
There's other parts of your company I want to discover. How about that?
Very good point. I think that it is finally a computer science operation. I mean, there is applied to finance, but we are 40 people, and I think 32 of us are engineers. We are working on all parts of the infrastructure, data infrastructure, security, sort of cloud deployment, using Hadoop, Spark, big data technologies, how to store and maintain data such that your studies can run very quickly. Finally, neural networks and machine learning operations, they are very compute intensive. They need a lot of resources, and it can quickly run up to a big bill unless you sort of work on optimizing it.
Yeah. Hence the term big data, big bill.
Right. Yeah.
Okay, let me move forward. Does the emergence of AI mark the end of the human trader?
No, I think that, there are many analogies. One of the favorite analogies I have is that of a pilot. We have more pilots today than we had 30 years ago, yet autopilot is a great technology. That doesn't mean we don't need a pilot or two pilots in the cockpit. They just need to, like earlier it was about being strong, being able to handle levers. Today it's about knowing the technology that you're working with, knowing its strengths and weaknesses, and almost reading what the technology is doing, almost understanding what it's, what it might be missing right now. So we will find the traders evolve with the use of this powerful tool. Sure, one will need to change their ways. In fact, one will need to do less of the tedious work that now computers can do. But I think that it will lead to more efficient, high return trading performance.
Well, I think what most people want in the end result is not necessarily the highest return, but the steadiest. And is that what I'm getting from you? Is that what you're bringing to the table?
Exactly. And steady returns essentially comes from handling all sorts of data. Like, for instance, of this threat of trade wars. How do I handle that? All I have is a 20-year-old history of expected returns, it cannot figure in the calculation. How do I handle all these different types of information that I'm getting to shape my sort of expected returns model a little bit? That's what AI brings. And I think that that leads to a much more steadier investment performance. One word I want to focus on is investing versus trading. I think the future will be more about investing and not trading. Trading was typically something people would do when there would be outsized returns of very short-term patterns. And while I'm not a believer of 100% market efficiency, but I believe with adoption of AI, there's very high opportunities of short-term profit from trading. They will go away, or they will be much less.
Do you find that the people that are more open to using AI are going to be found in the crypto world and the crypto trading versus trying to go up against the behemoths of the major pension funds or endowments or things of that nature, bringing AI into their portfolios and using it versus the advanced thinking that we're seeing in the crypto world?
You're right. I think that a lot of early adopters of crypto are also adopters of financial technology, leading edge financial technology. And I think they are the family offices or ex-traders and people who have seen new powerful technology give them an advantage. So yeah, they're the same players who are interested in using AI in investing, in asset allocation, and trading. However, I think in the pension fund space, I'll point you to a few things. So we are actually working with a sovereign wealth fund in Singapore, a pension fund in Canada, and we're writing code together. We are writing strategies together. Japan Pension Fund recently publicly said that they want to adopt AI-driven methods, and they're working with Sony for that. So there's a lot of movement in the pension fund space as well.
Let's bring out the risk of investing with AI. Cover that for a second.
I think the biggest risk is that there's a lot of work to be done, and it's not something that you can cut corners with. I think that if for instance, if you see a fund with two people and they are saying, "Oh, we are using AI," then that's a risk, because there's so much work with very less investment. You're more likely to expose yourself to risks of overfitting, to security risks, to just being wrong about so many things and not knowing it. It is a much bigger enterprise than earlier trading operations were.
In your opinion, what's the biggest driver behind the adoption of AI?
I think trading has just become so hard. I think, the simple stuff doesn't work, and we need all investors need lower fees. I think the 2 and 20 model is certainly not. It's not working. It's not profitable. It's politically, not looked well. I think that investing needs to change. I think it needs to be more effective, and I think that's what will drive AI.
Okay. For those who don't know, let's clear this up for them. The difference between Quant and a data science-based approach.
Very good point. So Quant was sort of a mathematical approach of modeling the data space, trying to see what distribution it is and how to, once you know the distribution, you can try to fit Monte Carlo or integral calculus methods to find the expected price. You can sort of, once you make the mathematics concrete, you can find a price, what's a fair price. But in data science, you don't go the mathematics approach. You take all sorts of data and you just try to optimize your function on the data that is given to you. Do not do this first step of writing a mathematical formula and writing calculus formulas on it. You're just trying to understand the data inside your computer models and purely trying to optimize the objective function, which in this case is investment returns.
Well done and well said. All right. Last question I have for you today, and I'm sure everybody's on the back, it's got it in the back of their head. What will happen if everyone starts using AI, which eventually we're all going to have this tool?
Yeah, I think I think that will make everyone an efficient, effective trader, investor. That's my goal. Growing up, my dad, he worked very hard. He would save everything he can for himself and his children. But looking back, I could tell him that, hey, you did so many things wrong in your investing, but he didn't know. The tools that he had at his disposal were very crude, where did not work for him. Our goal is to reach a state that this AI-driven machine is available to everyone, and they're all effective, efficient investors.
Well, my question is this, do you think that AI models will start being pitted against each other, and who's got the better AI modeling system to, like high-frequency trading? When it first came out, the objective was to get to the market first and fastest, and in and out faster than your competitor. And I see that we have AI model wars going on with these behemoths once it becomes a generally a standard acceptable procedure.
Yeah, I think no, I see that happening now, and perhaps in the high frequency space or the short term trading space, people will do that. But I think it only serves to increase the noise. I don't think it actually leads to better progress. What I think is going to be is that people will start understanding that all these AI models are all kind of doing the same thing, and slowly people stop competing against each other, but kind of everyone will start sort of raising, like getting to this platform of using AI, if you will. It'll elevate people to an equal ability to handle market data. I don't think that AI, the models the way they are, I don't think that's about so much competition against each other.
The thing that comes to my mind, in my opinion, I could be wrong, but we are still early in the development of this industry sector in the investment world. It's subject to opinion at this point. It seems to me that you can never take competitive attitude out of humans, which are the ones that employ the AI, or tweak it, but it may raise the bar of awareness and the acceptability of common standard procedures with the use of these new tools you're bringing out to the world. Am I correct on that?
Absolutely, okay.
I want to push the envelope just a little bit before we close on this, because from my understanding, your models have been able to exhibit an extraordinary ROI for the people that have been able to gain access to the technology you're using without hitting a hard number which would get you in trouble. Am I correct in that assumption?
Absolutely. So, well, to start with, when I started trading in 2005, I was given $10,000 risk to take, like any other person in that firm. It was a typical arcade firm, and if you lose $10,000, you're out of a job. But from that, I was able to make about $700 million in 5 years, and in a very, very steady rate. It was not up and down. Every day making a little bit. And then I started my own company doing the same thing, and we did really well, similar rates of return. And at QPlum, we are targeting a lower frequency space, so not that high rates of return, but we have been very, very steady. I think our deepest drawdown is just 2%, and our cumulative return so far is, I think, upwards of 28% since inception.
Yeah, you really toned it down a little bit, but that program of moving that high ROI is still there. Yeah.
The world is slowly changing, and people are, like I mentioned, it's there's a lot of adoption of new technology. A lot of people are using, machine learning based methods, especially in the proprietary trading space. So it's not as easy as it was back then, but yeah, it's still there.
Wow. All right, Gaurav, thanks for being a guest on the show. Appreciate it.
Thank you very much for having me.
My pleasure. You've been watching CEO Money with Michael Yorba. Don't forget to like us on Facebook and subscribe to our YouTube channel. We'll be back with more great content for you. Thanks.